Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, my name is Ryan and I am a mortgage nerd. I'm a local mortgage expert here in Southern Utah. I've been doing mortgage loans since 1999 and really enjoy what I do for a living and love talking about the mortgage industry, real estate, that type of stuff. I also want to highlight a little side project that I have. If you can see, I'm wearing kind of the hoodie today. Let's see if I can get there right there. It's N3rd N3rd, and I nerd out on all kinds of different stuff. And I thought it'd be fun to just have some shirts and some hats that had different type of nerd categories. And so I've just created a bunch of these logos and a couple of things I just think are really, really fun. So if you go to nerdmerch.com, it's not just specific to this radio show or this podcast. They're just fun ways to show off your nerd. There's mugs, there's hats and shirts like science nerd, car nerds, math nerds. I've got IT and computer nerds. I've got like book and comic book nerds. I've got card game nerds. There's these just fun logos that I've been able to come up with. Sports. There's all kinds of things that people just nerd out for. And I just thought it'd be fun to have a place to put all that and to be able to just show off your nerd. So if you like to just get enthralled with certain things, and the OG category that's right there on the screen's just got some cool ways to put nerd into different things. There's different hats. So check out nerdmerch.com, and nerd is with a 3 instead of an E. So it's N3rd. It's just a fun way, kind of a play on words, kind of a gamer tag kind of use of the word nerd. I just thought it was really a lot of fun. So check it out. Buy a hat. I don't have like huge profit margin on this stuff. It's more for fun. It's just more to show off that I just like being nerdy on stuff. And there's so many things I like talking about. And so I thought it'd be fun to have hats and shirts. So I'm repping one of the shirts right now. So anyway, check that out. So today's topic, let's go to slide number 1. Today I want to talk about some of the mortgage loan documents and checklists of some of the things you need to gather up when it comes to getting a mortgage loan. We're going to talk about the 3 C's of lending. We're going to talk about the different income types that we see. Then we're going to talk about the most common paperwork we need for a mortgage and the most common mistakes with that paperwork. So that's what I want to dive into today. So let's start with slide number 2 here, the 3 C's of lending. Now I've seen the 3 C's in lending for mortgages, for cars, for almost everything. It's kind of funny how these things play out with all types of lending. The first C is credit. So obviously a lot of loans are going to be based on your credit history, your credit score, your report. That's one of the major things that lenders look at to determine what type of loan you're going to get. The next C is capacity. This is your ability to pay back the loan. This is reserves. This is money in the bank, time on the job. It's all the factors to say, okay, if we loan out X amount of dollars, what's the likelihood they'll be able to make that payment? So the capacity to pay back the loan. And the last C is called collateral. So what is on the hook that if the payments are not made, that loan is secured against something to return that investment or return the money that's loaned out. Now, the better the collateral, the cheaper the rates and terms. That's why you'll see better interest rates on a mortgage than you will on just a signature loan or even a car loan, because the mortgage and the home isn't going anywhere necessarily. So it's something more fixed and permanent and a residential structure that's easier to take back. And there's a sense that homes will go up in value over time more than, say, a car loan or some other type of loan. So these 3 C's will determine the type of loan program you're going to get, the type of interest rate, the payment, the terms, and the type of documentation you'll need to prove to get that particular loan. The more paperwork and the more of these hoops you can jump through, typically you're going to see the better interest rates because you're lowering the risk of offering that loan. The higher the risk, the higher the interest rate. And that's true on every loan. I mean, mortgages are a little more complex because of the dollar amounts and the type of regulation that follows mortgage lending, but almost every type of lending is going to fall, and all the documentation we need are going to fall into one of these 3 categories. So now let's kind of dive into each of these a little bit more specifically. So we'll jump into slide number 3. This one here is I want to talk about different income types. So with income, people make their income in basically one of these three categories. You're going to have people that are self-employed. These are people that get 1099s or they're They're working for themselves. They have LLCs or S corps. They have some way of generating their own business. They're not relying on a W-2, a pay stub, that type of thing. And self-employed can be all kinds of different things. White collar, blue collar, that doesn't really change whether you're self-employed or not. It's just whether that income is derived from and what expenses are tied to that income. Like, for instance, the equipment or the inventory that you have to supply for your shop or something like that. So when we do a mortgage loan on people that are self-employed, we typically get 2 years of their tax returns and we take their adjusted gross income. So after they've written off all the business expenses, maybe they have employees they pay, maybe they pay themselves a wage. There's lots of different ways. I see tax returns for years now, and there's so many different ways that the money gets filtered through the business down to the individual, or whether they try to write as much off as possible to be able to not have to pay a bunch in taxes. So here we are at the first of the year. We're here 2025 when we're recording this. A lot of people that are self-employed are going to start gathering up their stuff to file their tax return. I cannot stress this enough. Before you file the return, if you're thinking about buying a house or refinance is on the horizon, have someone like me or a mortgage company review those tax returns before they're filed. There's so many times I'm able to move some things around or reclassify or just kind of question where some of the expenses are going that we can add back into the income to use as income for the loan. There's so many times I see attached statement on the tax return. It's all these expenses all lumped in. There's certain ones that are categorized, but then once they don't fit those categories, they just go into like a lump statement. See statement A, see statement 1. I guarantee you, everybody that's self-employed, pull out one of your tax returns and something like that's going to be on your return. Then you go to that statement and it's a categorization of a bunch of stuff, a total number that's moved onto that page. I cannot tell you how many times I've asked about those expenses and see if they can be moved into depreciation or moved into another category. And almost every time I ask that question, something can get moved. And because of that moving it around, you still get the deduction, but we get to add that back in potentially to your income. So you get kind of the best of both worlds. It's something that is wrote off, and then you get to add it back in as income. But if you don't do that, you file your 2024, your 2023s if you haven't done those yet, or 2025 in the future. If you don't know and don't have a review done on that, you could be leaving money on the table, and now all of a sudden you can't get a conforming loan because you wrote off too much of your income. And so you have to go to these other types of loan programs. So we do have loans with self-employed that don't require tax returns. They use business bank statements and add up deposits going through that account. There's profit and loss loans. There's 1099 loans. There's all kinds of different loans, but the rates and terms are going to be worse because they're not able to use the tax returns to show what you've actually claimed. So it's important that you do it now, because if you're going to be buying a house or refinancing or anything, they're usually looking at a 2-year window. If you did 2023 and just wrote it all off and have massive negative income, you have to claim way more in 2024 to offset that, or now you're waiting until the 2025 return. So self-employed, there's a little more moving parts with helping you get the best loan possible. And part of that is just planning ahead and having somebody kind of review the returns before they're filed. And I do it all the time. This time of year is kind of through April and even through October at times when people do their extensions. I review a lot of returns and say, hey, if we can move this around a little bit, or based on this return, this is how much you qualify for. If that's not enough, then you got to go back and reduce some of your expenses. And then you can talk with your CPA and say, hey, if I have to bump this up, how much more will I owe to Uncle Sam? Is it worth it? But having those conversations now is better than trying to fix it or do an amended return or having to wait an entire year until your next tax return is done. So with self-employed, especially before you file, have it reviewed. Just have it looked at by a loan officer. I'd love to help you with that and just be able to tell you, okay, based on this income, this is what you qualify for. If that's not enough, here's some suggestions on where to move some of that income. So we got self-employed as one of the top income types. Next is wage earner. So these are people that have a pay stub, W-2, an hourly wage, a salary, whatever it is that's a W-2 they receive from their employer. And so typically we don't see as many expenses being written off. There still can be, but it's just a different type of income that we're looking at. What I see most common with wage earners is they'll tell me they make X amount per hour and they work 40 hours a week. But then we get their pay stub and their year to date is way different. And then you have to go back and say, okay, was there a raise? Was there some major time off, a maternity leave? Was there something during the year that when we look at your year to date, it's way less than that 40-hour average? And you usually have to get some explanations for it. But that's when I'm trying to do the application with clients. I try to make sure I use kind of a worst case number on their income, because a lot of people will frankly just overstate it, because they'll just, I make X amount, I work 40 hours every single week, and then we get the year to date and it's way less. The other thing we get tripped up on is getting the verifications of employment from employers. Many are starting to go to third-party systems to get verifications, and they require a salary key is what they call it, or work number is another one that we have to get this. We got to get this code that we can then access some of that information. And if we don't get it quickly, that can just be a delay in getting some of that paperwork together. We also have to get the actual full pay stub. I see people give me like screenshots or printouts that aren't the actual pay stub. And sometimes people don't get those anymore. They don't come in the mail anymore. You have to go online. You got to go to ADP, or you got to go to whoever your payroll company is and get that. And people sometimes don't have their username and passwords for it. So just ahead of time, know we're going to need to document 2-year tax returns for self-employed, usually the W-2s and pay stubs for wage earners, and they will do a comparison between the W-2 and the year-to-date pay stub and just see if it's going up or down or what has changed over that course of time. And then the next one is going to be fixed income. So these are people that are on Social Security or disability or pension, retirement, annuities, some sort of fixed income where they get a check every month, direct deposited into their account. For any of these things, we have to verify that it will continue for 3 years. So if it's a temporary disability or temporary benefit, we're not able to use that income. This kind of falls a little bit under child support and alimony. We can use it, but we have to show it will continue for 3 years. So when we get the divorce decree, that usually will list the name of the children or the amount they're supposed to get. A lot of times now we'll see that there's a date of birth on there. If they're over the age of 15, we usually can't use that part of the income. So just recently I had a client that had 4 kids. One of them just turned 18. Another one's turning 18 in a couple months, I believe. So we can't use those 2, but we can use the other 2 that I think were under 15. The other thing we have to do with child support is we do have to show the payments have been made for the last 12 months. Unfortunately, we see a lot of times where child support is owed and it's not paid, or it's not garnished yet, or ORS here in Utah hasn't started to collect the payment from payroll and then get it to the recipient. A lot of times those payments are missed. So we have to show that it's been consistent for the previous 12 months and that it's going to continue for the next 3 years on anything kind of falls under that non-wage earner, non-self-employed incomes like annuities, pensions, child support, alimony, that type of thing. Now, one caveat as well, I'll have people say, well, my kid's going to be turning 18, but he doesn't graduate until a later date, or he's going to go to college, and part of the decree says that if he goes through college, then it counts. Usually they won't count that because it's based on having to do the college thing. So almost every underwriter is going to go right to the age of 18. It has to be more than 3 years before they turn 18. So as soon as they're 15 in one day, it's very hard to use that portion of the child support. And I see too many times that people need that to qualify. And if that does go away, that's going to make it harder to qualify. So really, it's better not to have to use it because it could stop. Or if you're having to get that income to qualify and all of a sudden it does go or stop or cancel or something like that, that can be a little bit scary to put you in a mortgage that now is a big financial burden if all of a sudden part of that income does go away. But we can use it. There is guidelines for everything. There is a guideline. There's an underwriting scenario for almost anything. I mean, the books of these underwriters are just massive on these programs. And there is lenders that won't need to follow those guidelines, but the rates and terms can be worse. The more you can kind of fit in these boxes, that the better lenders, the Fannie, Freddie guideline type loans, that's typically where you're going to see the better interest rates. All right, let's go on to our next slide. That is income types. The next thing I want to do is the most common paperwork. So as we talked about those 3 C's, the most common paperwork you're going to have is the income verification. Almost every single time we're going to be going off of 2 years of the job history and 2 years of the income. This will be tax returns, W-2s, pay stubs. With pay stubs, they typically want to see 30 days worth. Most people, I would say, are paid twice a month. You do see weekly still. There's people that get paid every Friday, but I'd say probably most common is either every 2 weeks or a first and a 15th, that type of thing is what you're going to see the most common. So they will have to get that pay stub, we'll have to get that income, those verifications taken care of. And with the verifications, they will call in to make sure that you are employed, what your position is, last raise. There's verifications we do with the employers as well. Next is asset verification. So most loans, even if you're doing 100% financing, want to see that you have some money in the bank left over, that if you were to lose your job or a health concern or something were to pop up, that you've got a little bit of money to fall back on. It's anywhere between 0 to 6 months worth of the payment. Now, the reason I say 0, it can be because credit scores don't requirement, or there's really good debt ratio. There's things that allow it to not have to have any reserve, but almost every loan is going to require you have some money in the bank, usually somewhere around that 0 to 6 months worth of the payment. Now, that can be a 401k, it can be a retirement, IRA, it can be some sort of retirement account, but they'll want to see the last 60 days of that account. A lot of it comes into money laundering rules and just seeing where the money was before it was used for either down payment, reserves, anything like that. And a lot of times also when you're going through the home process, you're going to have a home inspection fee. You're going to have an appraisal fee. You're going to have some other things, earnest money that you'll put down that needs to be sourced and seasoned is what we call it. And they'll look at the last 2 months of the bank statements. And I would say that is where most people get tripped up, is they'll have a large deposit show up within that 60 days. That's a gift from a family member, a car that was sold. I mean, all kinds of different things. And we have to paper trail any of those large deposits. And so it is something where it's not just sourcing the down payment and verifying the down payment. It's also making sure that you have some money that is left over after those expenses. And the next is the property. So with the property, we're going to be getting a title report to see who the owner is, whether liens, the title is going to show us a bunch of things about that property. We'll also get a home appraisal, which is something that is a valuation based on what you're buying the home for or refinancing the home for. So that's some of the paperwork that we're going to get. And then we're going to need to get some sort of homeowner's insurance. Now, this has been a big issue as we've seen hurricanes and fires and all kinds of stuff. The cost of insurance really has gone up a lot in just the last little bit because the cost to repair everything has gone up so much, and trying to get contractors, and they're paid more and the materials are more. It really has kind of been an echo effect of all the inflation over the last few years, because as claims start hitting these insurance companies, they're just way more than they used to be. What used to be 10 grand to fix is now 20. And so those premiums were kind of absorbed for a while. Now the insurance companies have had some big losses the last 2 years, and they're starting to raise premiums or just not insure at all. We're seeing places where it's really hard to find the insurance, especially with fires. That's become, especially out here in the West, the dry West, we're running into a lot of issues when it comes to fire zones and areas that are listed as high fire. Like I've got a couple places here in southern Utah that certain insurance companies just won't loan. They've kind of zoned that area and said, nope, we're not going to loan in that area. Or not loan, sorry, insure that area. They're not going to insure that particular area. So it has definitely been a concern. The cost of those have gone up. But it is something where every home we do a loan for, we need to make sure that there is the insurance on it. And the insurance can be either the HOA, if it's a dwelling that has shared walls, you usually have some sort of master policy that covers the entire building, or a regular homeowner's insurance policy that just covers that standalone building. But that's part of the property. So we have title, appraisal, and insurance are the most common paperwork that we have to gather up on refi or purchase every single time. And with a purchase, you also have the contract itself. What are you buying it for? What are the conditions to buy it? What are included in those conditions? Home warranties or any of those types of things. There'll be a contract that explains what's happening. Or if there's any repairs that need to be done or what's included in the home, that's part of the paperwork as well for the property. So most common, you have income, asset, and property. Almost everything that we need for paperwork is going to fall into one of those buckets, if you will. All right, let's go to the next slide. So here's some of the most common mistakes I see. Some of the most common mistakes I see is people waiting too long to get pre-approved. We've said that on the show. Every mortgage lender is probably going to tell you the same thing. Waiting to get pre-approved is a big mistake. There's so many times that if I just had a little more time to work on credit or gather paperwork or season bank statements or a raise is around the corner, there's just so many things that if we had a little more time, started the pre-approval early, will never hurt you. I've never seen a single time, well, we shouldn't have done that. It's almost always we're making sure our ducks in a row. We can gather paperwork. It's so much easier when you have more time to gather paperwork than it is all of a sudden you have a deadline of 2 weeks or usually 30 days. I'll get contracts that have shorter than that, and it just becomes more of a scramble. And you just end up missing deadlines, risking your earnest money, trying to move out, move in. I mean, there's just so many things that become a problem versus just getting pre-approved early. Just don't wait. Get the credit pulled, get ducks in a row, get paperwork going. So then when you find a house, you can close way quicker because you got everything ready to go. So I'd say waiting on pre-approval is one of the bigger mistakes people made. The next one is bank statements. This is where, again, people will start moving money around, have these large deposits show up. Realize as lenders, we're going to look at the last 60 days, the last 2 months of the bank statements, or quarterly if it's some sort of retirement account or something like that. But most of the time, we're dealing with checking and savings accounts. The most common thing I'll see is they'll say, okay, we got all the money in 3 different accounts. We're going to move it all into one account so we can verify it. Well, that move happened within the 60 days. Now we have to get all the bank statements for everything. You're better off just leaving the money where it's at, just verify it. And then if we have to write a couple checks to the title company, we totally can. But I'll see people try to move money and then it becomes a paperwork headache, or they get money from a family member, give funds, and all this money moves around. Well, anything that moves in the 60 days, we have to source and season it. So it just becomes kind of a paperwork rabbit hole that gets really tricky. The other thing we need is the actual bank statement. So we can't use the mobile app and just print off like your transaction summary because it doesn't have the name of the bank. It doesn't have your name on it. It doesn't have the available balance. There's so many things those transaction summaries don't have that just don't fill in the gaps of what we need. So we're always going to need the last 2 months of bank statements, and then we can bridge the gap from, say, the end of the month to the 10th of the month for, say, your earnest money deposit, because it'll happen in between the statements. But it is the most common frustrating thing for clients to have to get is these bank statements and verified deposits and what is this, and kind of digging into those bank statements, where if all the money was just kind of already there and saved, it would save you a lot of headache and a lot of paperwork stuff. So just keep that in mind. Bank statements are probably the hardest thing. We do need the actual statement, not just a screenshot. The next one is overstating income. And again, this is what we talked about a little bit, where people will say, well, I make X amount per hour. I work 40 hours a week, divided by 52 weeks a year. And that's what we are supposed to make. But it doesn't always translate to that when we get the year to date. So we don't, we want to make sure that you're kind of safe with that, or when you're explaining the income, that there is a buffer for kind of any time off or any trips or anything that makes it kind of less than that. Because a lot of times people are less than 40 hours when you divide it out by the whole year, because of time off or week or paid vacation or something like that. Now, there's also people that go well over 40 hours. There's jobs that just are overtime every single week, and that's a different calculation. But it is probably the most common thing I see on the application. So when I'm talking to clients, I always kind of try to take a worst case. I always try to take a lower number when I state the income until we actually get the verified documents. And the next one is the big one that everybody talks about, and that is opening new debt. So you get your pre-approval, and all of a sudden think, oh, we're getting this house. I want to go get a new car, or I want to get the appliances, or a furniture package or something at Furniture Row or somewhere like that. And that is a big no-no, because even after we pull credit and get you an approval, they'll still do another check. They do an alert to make sure new debt isn't acquired, because now we have to add that debt to your debt load. So just don't get new credit, open up new accounts until you're done, closed, keys in hand. Just wait. I've seen some deals just blow up because somebody went out and they got all excited and they want to get a car with the house, and now they got this $600 car payment we have to factor in, and now they don't qualify. It's not a fun conversation, and it's something I think our industry has done a pretty good job of warning people not to do. Now, it's different if you have to go get utilities. That can be different. They can do a credit check on that, but it's a different alert. It's not a debt you're trying to get, like a furniture package or appliances or a car or a Visa or just something else that's on there. But also, if it's already an open account, I've had people call me and say, well, I've got this Visa, I've got this trip I got to put on my card, my business card or whatever it might be. Is that okay? Yes, that's already an account that's on credit. It's an active trade line. There's a debt ratio with it already. It's really new cards. Anything that opens up a new account is where you're going to run into the biggest issue. So I hope you found this useful. If you have any specific questions, I'd love to work with you on purchase or refinancing a home. So I want to help you with any of that. Check out my website at ryanbolton.com and we can get started. I help in Utah and Nevada. So I'd love an opportunity to work with you on any loans. We do first, HELOCs, investment property. I mean, I sell money for a living is what I tell people when it comes to buying real estate. So I'd love an opportunity to work with you. Check out ryanbolton.com. We can talk on the phone. We can set up a meeting, whatever we happen to do. But really enjoy doing this with you. If you have any questions, reach out. Have a wonderful day.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717.
This has been a production from a podcast studio.